All right, so how to put some yield into the fixed income end of your portfolio without some of the risks that come with investing in high-yield bonds. Kristen Ceva makes the case for looking to non-U.S. debts as a diversifier. Kristen is the head of Global Fixed Income Group at Payden Rygel and joins us from Los Angeles. Kristen, welcome to the program.
Thank you, Pimm.
Kristen, go ahead. Explain a little bit about this whole world of emerging market sovereign debt and why you think that that is likely to outperform the sovereign debt of developed nations.
Well, as you know, we've seen a lot in the media lately about the problems in the G7 countries in terms of their debt to GDP ratios increasing, the fiscal deficit issues, deleveraging, and the emerging market countries really don't have those types of problems. Their debt to GDP levels are half those of the G7 nations. It's the same thing with their fiscal deficits, about 3% as opposed to 8% in the G7. Didn't have the same problems in terms of leverage either in the banking system or the consumer sector, particularly in Latin America and Asia. So we think that structurally emerging markets are well positioned to achieve higher growth rates going forward, double that of the G7, and also well positioned just in terms of economic fundamentals, and that will support their bond markets to outperform the G7.
All right, now, Kristen, since many of the nations that we're going to talk about, I mean, they are net creditors, meaning they've got, as you say, they've got the, more Forex reserves than they owe.
Right.
Is there a situation where everybody kind of knows this, so there's not a lot of value left?
I don't think so. I think that there's a lot of value left, particularly in the local market area, because we think that that growth in emerging markets is really going to support the emerging market currencies. And in the local markets, you get the return not only from the bond, but also from the currency appreciation. So one of our top trades, for example, in the Asian space, where we have the most conviction on currency appreciation, is going to be Indonesia. So you're getting a 10% yield for a country that's an improving credit story, where we think the currency is going to appreciate, and we think that that makes a lot of sense in terms of valuations versus other asset classes, also versus the dollar pay Indonesian bonds in the EM space.
What about just let me push in, let me just ask you, Kristen, what about liquidity? Is that a concern?
I think that the liquidity in the local bond markets have really improved over the past 3 to 5 years. The foreign taxation issues have really improved, as well as the bid-offer spreads in the local markets. So it's much easier to transact in these markets, and also their yield curves have built out over the years, so that you used to only have options in the front end of the curve. With local pension funds really becoming players in these markets, you have much better built-out yield curves where you as an investor can invest both in the short end and in the long end.
All right, now you mentioned Indonesia. Talk a little bit about Brazil. We speak about it a lot in terms of being one of the star emerging markets. Do you like that sovereign debt as well?
We like, again, the local pay in Brazil better than the dollar pay. We think the dollar pay yields are a bit overvalued. So on the local side, though, at 13%, those are some of the highest yields in all world bond markets. And you're still supported on the currency side by increasing FDI flows that we expect to see in 2000. And we think that, again, when you mentioned the net creditor status, that fits a country like Brazil that has done a tremendous job in managing its debt to GDP. So all those indicators really point to Brazil still doing for us, but on the local side. And we also like in the local markets some smaller countries like Ghana, where you're getting a 19% yield for a country that has both political stability and also it's a natural resource play. It was a recent discovery of oil, which is going to come online at the end of this year. So I think that's a nice upgrade story and a nice yield story as well. All
right, now in mentioning natural resources, Kristen, tell us about some maybe quasi-sovereign debt. I mean, for example, Gazprom, that's one of the others on your list.
Yes. I think that Gazprom is an interesting oil and gas play. It's 50% owned by the Russian government. You're getting a nice pickup to what you're getting in the sovereign bond for essentially quasi-sovereign or almost government risk. And again, it's one of the top 5 natural gas companies in the world and very strong strategic importance to the Russian state. So we do like those types of quasi-sovereigns. A similar story with Quasi-sovereign. Munigas in Kazakhstan, which is 100% government-owned and the largest crude producer in Kazakhstan. Other quasi-sovereigns are interesting as well. We know that there's been interesting developments in Dubai, and that, however, we don't see the contagion affecting Qatar in any fundamental way. That's going to be one of the fastest growing economies in the world, and we like Qatar Telecom, for instance, which heavy government ownership and a great company reaching out to the Middle East and Asia.
I want to thank you very much, Kristen Ceva, head of Global Fixed Income Group at Payden Rygel, joining us from Los Angeles. Coming up, talk about Ukraine.